Alright traders, what is top-down analysis? Make a video about top-down analysis. This is the question I've been receiving from almost everybody on my YouTube channel, on my WhatsApp, in my email. Now I'm taking time to do this. What I'm going to do in this video is to break down everything for you. I want to make it as easy and as simple as anything you could see on the internet. All right, so let's go into this video. I want to make it in such a way that the next time you come to your chart, you will not struggle with understanding what is on the chart. Now, before you talk about top-down analysis, there are other steps that you must make sure you have fully understood. Things such as time frame. All right, because time frame is the major problem of a lot of you people, how to navigate through different time frames. You know, when you come over here on your trading view, you see all these time frames and you get confused. Sometimes you are not able to chart your way from the daily time frame down to the 1 minute time frame. Now, before we jump into the top-down analysis, all right, there is something I want you to also understand. For you to be able to do top-down analysis properly, you must have to understand the type of trader you are. There are basically two categories of traders, and I want to fully explain that to you. Please be patient and follow through. So look at this. We have two categories of traders. We have the types of traders called the aggressive traders and the conservative traders. Each of these traders, they have their advantages and they have their disadvantages. So if you fall under aggressive traders, you must have to find your time frame. Now, if you are struggling with patience in the market, you know, one of the problem of a lot of traders is the ability to carefully sit down and watch price. Take 1 hour, 2 hour, 3 hour, 4 hour, 5 hours, 6 hours, retracing into a point of interest. It's not necessarily because you don't know how to trade. It is mostly because of impatience. So this is where the type of traders come in. If you fall under aggressive traders, you will struggle with patience. And that is where you will have to operate in the lower time frame. That is why the time frames is divided and price is behaving in fractal. So you could find everything you want to see in the daily time frame, in the 15-minute time frame and 5-minute, because that is how the market is designed. So aggressive traders wants to operate around that area. And then a conservative trader will find it comfortable to be patient. They are not in haste to take trades. They can be patient for 2 days without taking trade and take trade on the 3rd day. All right. So one of the things is this. An aggressive trader takes a lot of trades, maybe 3 to 4, 5 trades, 7 trades in a week. And he ends up getting like 3 trades work in his position, or maybe 4 trades or 5 trades. A conservative trader may not be able to trade throughout the week because the setup did not come. Now, if a conservative trader is preserving his money, an aggressive trader might have lost money or might have made money over a conservative trader. So there are so many things about this. I will take time and explain these types of traders for you in a separate video, but then when it comes to top-down analysis, you need to understand which category you are. So now, what time frame do you belong to? If you are a person that operates on the 1 hour time frame downward, you fall under the aggressive trader. If you are a person that operates from 4 hour time frame upwards, you are a conservative trader. So if you're doing your top-down analysis, you must have to know what you are doing or what time frame to look out for. All right, so this is it. This is gold, right? This is gold. I'm looking at the chart for gold, and if I go to the daily time frame, now I am an intraday trader. I don't care what is happening on the 1 week. I don't care to know what is happening on the monthly. I just want to make my money immediately and leave that place. Now look at this. Are you looking at what I'm seeing on my chart? What do you do when you come to your chart like this? What do you do? Now, I want you to learn how to pick a data. When I say data, is how to pick the raw information here. Look at this. Do you want to do business with this place? Here or here? I have no business here. The only place as an intraday trader I have business with is this small chunk price movement. All right. Because I'm not spending forever in the market. I'm spending maybe 4 hours, 5 hours to be out of the market. So within a day, maybe in a particular session, I take trade. So this is what I'm going to do when I come to my chart. This is how to do it, guys. You look at your chart. Look at what is the structure, or where is price going to. What is the structure and where is price going to? So look at this. Can we say that we are in a bullish market or a bearish market in this chart? You can answer the question in your mind. But we are in a bearish market. Why? This is it. Price move up, came down, tried to move to break this high that price created right here. If you understand this video, I am assuring you that you will definitely not struggle with understanding this concept. So price could not break this area. It created a low here, retraced 1, 2, 3 candles. And right here, if I put this line from here to here, what did you see? Price crashed below the higher low, which means a market structure shift. What is a market structure shift? It is simply a change of direction from an uptrend to a downtrend. Are you understanding? It's a change of direction from an uptrend to a downtrend. So look at this. As price shifted structure, what do you see? You are no longer looking at this place as your point of reference. Price is now using this place as your high. You don't want to see price break above that area. If you take out this area with the body of the candle, now you have to know what a structure is. It's a different video. I will make a video on that again, especially for you guys that are newbies. But if we close above this guy, it means we are back to uptrend, downtrend, uptrend, but we never closed. Price actually came here and dealt with this fair value gap, which is a very, very point of reference. And don't forget, you have a bearish order block. So price actually went back and dealt with that area and then came back. Look at what you have. Please notice how price did this. The low was here. What did you see after price went up? Is that not a break of structure to the downside? I want you to answer. That is a break of structure. So what is that supposed to tell you? That I am still bearish. On what time frame? On the daily time frame. First question answered. All right. I want to teach you like a baby now, because I know some of you need that. All right. So there are two types of liquidity. There is something called external range liquidity, and there is something called internal range liquidity. External range liquidity is the liquidity around old highs, relative equal highs, relative equal lows, or old lows. So what is this? Is this not a low? So there is liquidity below here, and boom, we have targeted it. The next place of liquidity is where? Here. Here. All right. So what do you call it? You call it external range liquidity. Anything outside is external. It's when we are retracing back inside that we deal with an internal range liquidity. And where can we find them? We can find them inside order blocks, fair value gaps, any of the 7 institutional reference points. I hope this is understood. I hope this is understood. So look at this. So we have swept external range liquidity. And what else did we do? We have even touched this bullish order block. Please don't forget the small details. Now, what do we do? Every time price sweeps external range liquidity, what does it do again? It goes back inside to reprice, to get a better energy for pushing further downward. Because this is just like a food. It has finished eating, going back to work, and come back to look for food. The next food is this guy. I hope you're understanding. So if you're putting your FIB level from here to here, because that is the swing. Now, this is what they tell you. This is what they tell you. Don't take a trade in a discount area or take a trade in a premium area. So if you are selling, you sell in a premium area. If you're buying, you buy in a discount area. So what are we having now? Discount. So is it okay for us to buy? Yes, but what confirmation do we need? So this is the only reason why we want to go to the lower time frame, so that we can get more confirmation. So time frame works like a calendar. Before you can get a week, you need days. Before you can get days, you need hours. Before you can get hours, you need minutes. So before we can get daily, we need the 4 hour. It's in this manner. Look at this. If you're jumping from the 1 month, the next time frame is the weekly. If you're jumping from weekly, the next time frame is the daily. If you're jumping from daily, the next time frame is the 4 hours. If you're jumping from the 4 hour, it's not 3 hour, it's not 2 hour, but 1 hour. Please get this. From 1 hour is 15 minutes. From 15 minutes is 5 minutes or 1 minute. So this is why we'll go down to the 4 hour. And notice this. The structure you have across every time frame is different. Is what is different. So this is why I will take out everything here and look at this from this perspective. All right. you need to understand this, because this is, I am sure this is going to change your perspective about the market. So look at this. We have on the 4 hour time frame, we don't want to look at those sides. We are now bringing ourselves closer to where we can take trades, so that we can be on the advantage side of the trades. All right. So we know that we are in a discount, which is the place we are supposed to take trade, to go back into what? Into internal range liquidity, because the daily has told us that we have swept external range liquidity. Listen, if you are in a hurry, you can simply skip this video now and come back and watch it later, because I want to take time and explain this to the end. All right, let's go. So this is it. Price is coming down. What is this? Can you see this candle? Do you know what this candle is called? It is called a liquidity void. Why is it a liquidity void? Price quickly moved away from an area without giving equal balance. Watch my video on liquidity void. Every time price quickly moves away from a level, it wants to come back and balance it. Why? Because there are no people that are going to buy at this area. All right. For you to be able to sell, you need buyers. You definitely need people that will buy. So that is why price will come back to this area before you sell again. So this place must be filled. This is just like a vacuum. Imagine a pothole on a tarred road. It wants to be filled. So every time you see quick move, quick balance, quick move, quick balance, quick move, quick balance, quick move, quick balance, quick move, quick balance. You see, quick move, quick balance. Price does not leave this kind of potholes behind. All right. So look at this. We have price did this. Boom. What did you see there? Break of structure to the downside. This is now the 4 hour time frame. We are doing the structure differently. We have done the one for daily. We are now in the 4 hour. So look at this. Where is our swing? We have swing high, swing low. All right. Swing high, swing low. Have we finally balanced this guy? Now this is when you will start to look for, okay, what should I look for in this area? Where is the possible place that price will reach before selling again? That is the institutional reference point. So what can you see here? A breaker right here. A bearish breaker. So this is the possible place price will go to, because price doesn't move in one direction forever. So this retracement is going to come back to this area, and that should be your target. Now I'll bring in another concept. If you are a conservative trader, you will wait. Yes, this is where you begin to wait for price to come back here before you sell. Now this is where the conservative trader and an aggressive trader comes in. If you are that conservative, you wait. You surely want to wait till the end of this retracement into this area before you sell. So A conservative trader will walk away, and each of these candlesticks is 4 hours. You will have to wait today, tomorrow, because you have 6 4-hour candlesticks in a day. So once you have 1, 2, 3, 4, 5, 6, you are done for the day. You have not reached your target. You see them coming up to this area, then you sell. But an aggressive trader will say, no, I know price is going here, and this is the 4-hour time frame. I will take 2 days, 3 days without trading. How about I look for a shifting market structure in the lower time frame, and then I take the buy instead to this area, and then we continue the sell together with aggressive traders. Do you understand? So this is where the top-down analysis comes in handy. So what do you do next? You go to the 1 hour. Now you're coming to the territory of aggressive traders. So aggressive traders will say, okay, now we want to start buying, but price, please show us reason to buy, because all the other higher time frame have told us that price wants to balance this liquidity void. All right, so let me play it out for you from here. The aggressive trader is now in his territory, 1 hour downward. He says, okay guys, so I am here. We have this massive movement. Price cannot move forever now. It wants to retrace back into internal range liquidity. Where? To that breaker. You remember? So he is seeing it from here, but he is not in haste to take the trade. This is discount. It is ideal to buy from discount, but give me a shift in market structure. What is a shift in market structure? A shift in market structure is an assurance that price will really change direction. So at this point, price came, create this low, retrace, boom. What do you have? A lower high here. You have a lower high right here from the 1 hour time frame. So an aggressive trader is saying, okay, take out this guy and I will know there is a shift in market structure and I will buy to that side. Do you understand? And this is it. Price does this. He saw this movement and said, okay, this is what I needed. This is exactly what I needed. Price now shifted structure. I hope this is understandable enough. From the 1 hour time frame, he's looking at it and say, okay, I have shifted structure. Now give me a reason to go for the buy. But I don't want to take the trade in the 1 hour time frame. I will prefer the 15 minutes so that my stop loss can be small. So he drops down to the 15-minute time frame. All right. Are you looking at what I'm saying now? He's dropping down to the 15-minute time frame. You can see where your structure shifted here. He says, okay, give me a reason to buy. All right. Give me a reason to buy. He's seeing this. Now, some of these guys will start looking for a point of interest in this area to start buying. Now, somebody will look at this from the 4 hour time frame. I mean, the 1 hour time frame and say, okay, this is a fair value gap. I am not using this breaker block because this breaker block is in a premium and it may not be strong enough to hold price. So I will prefer to enter from here. I will start taking the trade from here on the 1 hour time frame. All right. I will start taking it from here. My stop loss is here and my target is going to be here. Yes, I don't want to be following what the conservative traders are doing. So this guy is taking his trade now. More aggressive trader will prefer to go down to the 15-minute and say, okay, but my stop loss is too big on the 1 hour time frame. Give me a reason to take it in the lower time frame so I can reduce my stop loss or I can reduce my risks. This is almost 66 pips or 71 pips. All right, 71 pips is what I'm seeing there. So look at this. On the 15-minute, this guy is looking at it. He's saying, okay, just behave. He's looking at this. All this while, now this is it. This is it. He has a break of structure. He has a break of structure right here to the upside. Break of structure to the upside. I hope you're seeing this price move, create this high, came back, failure to make that high, boom. So somebody is looking at this as a mitigation area, this place as a mitigation area. So somebody will look at that as a mitigation area for entry. You know, you cannot miss those entries all this while. And let me show you, more entries will come ahead. So look at this, more entries, price breaking structure, retracing, more entry. So as price keeps giving you opportunity, this is it. Now look at this. Look at this. Notice how price did this. All this one is for you to see where price is going. If you missed the first entry from the 1 hour, you wouldn't have missed the mitigation area. And there is a breakoff structure here that price pushed lower and grabbed liquidity around this area before going up to that side. So this is the final delivery you are seeing on price. You are seeing this final delivery on price. So price keeps moving. Keeps moving. At every opportunity is entry. At every opportunity is entry. Fair value gap, entry. Stop loss. Price reached here. You're watching it all through. So the conservative trader is not taking trade because of these things, while the aggressive trader is saying, yes, I can take each of these trade opportunity. Even here, somebody has taken trade. Here, you see, price came. This is, look, let me show you this. Price had this movement, boom, to that side. All right. Is that not a very good setup? It's a very good setup. What is this? A bullish breaker. Price came back, tap it with a lesser risk than the person watching it from the 1 hour. So look at this. Stop loss, maybe targeting somewhere around there. So is this not a very good trade for somebody? Maybe targeting almost 50 something pips on this trade on gold. Another setup happening right now. You see, you will have to learn this thing time and again. Another setup. Pushing above this guy. What do you have here? A mitigation block here. Another trade for somebody. Stop loss here, down here. You take the trade again from here until you finally reach that highest level. All right. So the least point you could go to is the 5 minute. If you are trading less than the 5 minute, make sure you are trading in the kill zone hours, maybe the 1 minute or the seconds. It should be in the kill zone hours. All right. But if you're going less than the 5 minute, make sure you are taking trade in the kill zone hour, or you can just stop at 15 minute or the 5 minute latest. All right. So that's basically what top-down analysis is. So as you're going up, you are making your money, while the conservative trader is saying, come back in the 4 hour before I join you. I hope this is explanatory to somebody, and I hope you have understood what it means to do this top-down analysis and be taking trades as price is going. So the conservative trader wouldn't have had any loss, but the aggressive trader, if at any point happens to enter the trade and then get stopped out, he might have, been stopped out from that point. All right. So this is how to go about it, guys. I will make more videos explaining this to you. Maybe every week we'll do top-down analysis videos so you will understand. Thank you guys for watching. See you in my next video.